I wanted to start off this morning with this image. It's from NASA. It is of the 2010 volcano eruption in Iceland. I don't know if everybody remembers that, but it was a really significant disruption to the airline industry. It basically grounded flights for 6 days. Over 100,000 flights were canceled, and it was said to have cost the airline industry close to $2 billion. So we might call that an industry disruption, pretty significant. But when we look at what the Harvard Business Review, so what the actual definition of an industry disruption is, it's a process by where a smaller company or companies with fewer resources is able to successfully challenge established incumbent businesses. So that's the definition of an industry disruption. Now let's look at what some of the common misconceptions are around industry disruption. It's that they're totally unpredictable, beyond anyone's control, totally mysterious, and random. So if those are the misconceptions, then maybe a better image for what an industry disruption looks like is this image, also from NASA, of a simmering volcano. So this is a volcano in South America that's constantly on watch, but not one that is causing flights to be grounded for 6 days and disrupting the industry to the tune of close to $2 billion. So if that's what the industry disruption really looks like, I would wager that based on that disruption, alternative proteins are in fact an opportunity for the animal agriculture industry. So it's an opportunity to leverage the disruption that they're creating and force some innovation and growth in the space. So what are we going to talk about this morning? 2 ways to handle the disruption. So I'm going to share 2 examples of other industries and how they've handled disruption historically. And then I want to walk through what the opportunity is, and then also a tool, so a technology tool that could actually help with that innovation and growth in the space. But before I do that, maybe you'd like to know who this person is sharing these insights. So my name is Renée Vassilos, and I'd like to thank J.J. Jones for introducing me to Katie and Katie for inviting me here. It's really a privilege to speak to all of you. I'm an agricultural economist by training, so I studied at University of Illinois in Champaign-Urbana for my undergrad and University of California, Davis for my master's. I worked for the USDA as an agricultural specialist at the embassy in Beijing, and then I realized government was not my thing, and John Deere hired me in China. So I worked for John Deere in China for about 5 years, initially looking at the China market, so how John Deere could grow the business in China. Then I owned China, Southeast Asia, India, and then I owned cotton and sugar globally for Deere from a strategic planning perspective. And then John Deere said, well, maybe it's time for you to come back to the United States. And I worked on the sales and marketing side of John Deere's business here in the US for about 4 years. I left 2 years ago. I really missed actually the innovation and growth that I experienced with John Deere's business in China. It just wasn't the same energy that we had in North America. The business here is a sustain business and not a grow business. And so I left and launched my own agribusiness consultancy. So for the last 2 years, I've been working with ag tech startups and the investor community. So working with ag tech startups on their business development and with the investor community on due diligence. So something that you guys have all been witness to in the alternative protein space is that we're starting to see more dollars coming into this world, but they don't necessarily understand agriculture. So that's where I come in from a due diligence perspective. And why am I here? So that's the background. And why I'm here with the time away from John Deere that I've had and some time to reflect, it's really been looking back at the industry and starting to ask some questions about maybe what some of the opportunities are and where there may be some misaligned incentives and where we can how we could actually bring more profitability back to growers and producers. And so that's what I feel really passionate about, and that's what I want to talk about here this morning. So back to the 2 ways to handle disruption. So let's look at the first example, the coffee industry. So about late 80s, early 90s, Starbucks hit the scene, and we could probably say that that was a disruptor. They brought an entirely new way of drinking coffee. So they actually took kind of the European model of bringing premium coffee to the space, and they also introduced a new way to consume the coffee. So they introduced the coffee shop experience, which wasn't really prevalent in the United States. So they came in, and the coffee industry was valued at about $4 trillion, the global production value. And when we look at the 2016 number, that has ballooned to over $16 trillion. So it's a very, very interesting disruption they had to the space. So again, they came in, they brought a premium product, and they introduced an entirely new way of consuming that product for the US market. So what happened? It was a chain reaction. So the incumbents in the industry started to innovate. They recognized that someone had come in and was introducing something new to the space, and they also upped their own ante. So we saw a lot of creativity around new products that were interested from all different producers, and also new ways to deliver that. So one example that I'll share is Nestle. I don't know how many of you in the room have had Nescafe before, their instant coffee. It is still the best-selling coffee on the planet, and is most often, especially in emerging markets, the first experience people have with coffee. So that is very much the entry-level economic solution for coffee drinkers. But what Nestle also did was recognize what Starbucks was bringing to the market and doubled down on Nespresso, which is a very high-end, at-home coffee solution. So it's a very high-end machine that delivers like very premium coffee experience in the home. So that's just one example where they recognized that Starbucks was creating a new opportunity, and they stood up and delivered. They have continued to be very successful. And in fact, there's also now Nespresso stores, so you can actually go and sit and have a coffee there. So what happened? It was a halo effect. So Starbucks really brought a solution and experience and value to the entire market. So by 1990, only 3% of coffee was sold at a premium in the United States. By 2000, that number was 40%. So that is an incredible growth of a market space. But what about Starbucks? So Starbucks was the one that caused the disruption. They still, when you look at where they sit, they still remain a very small share of the global consumption. So they helped raise all the boats in the space, but they don't own a majority share of the total pie. They just helped raise the opportunity and the dollars in the space for all of the players. But most of that is because the other players stepped up and people came in and innovated and brought new solutions to the space. So here I'll share a second way that you might handle disruption. So let's look at the personal transportation industry. So Uber and Lyft came into the market in 2010, 2012. And the vision, at least for Lyft, that's the company that I kind of studied, their vision was to revolutionize the personal transportation space. They wanted to come in, they recognized that the current services weren't serving the customers well, and they wanted to deliver another experience. And they really challenged the status quo. So they looked at how customers were being served, or not really being served well, by the taxis in the space, and they decided to introduce a totally new solution. What did the taxi industry do? So the taxi industry was in a monopolistic position. They dug their heels in, they fought it with legislation, and they tried to regulate their way out of changes in their world. They ignored the consumers who were very excited about this new solution. And the most disturbing was that they were actually in a tremendous position to take advantage of this new idea that was introduced. They had the cars and they had the drivers, which infrastructure is one of the hardest things to actually accumulate and to launch a new business. So they were actually in an advantageous position when Uber and Lyft handed them basically a new way of doing business. Instead of innovating and recognizing the opportunity that was presented to them, they didn't take advantage of that. They also had the knowledge. I remember in the early days, only 5 years ago, you'd get in a car and sometimes the map function wouldn't work and the drivers had no idea where they were going for the Lyft and Uber. But the taxi industry had established drivers that knew they knew their space and were good at what they did. And then also from a cultural perspective, people already had the systems down for how they ordered a car and how they got around. And so it was a real change to say, I'm going to get in somebody's car, somebody's personal car. That's quite a cultural shift. And I'm going to call them up on my cell phone through an app. So the taxi industry had fixed culture that they could have also taken advantage of. People knew how to get a car through the taxi services. That's what they were actually comfortable with. But again, they didn't really take advantage of that. Their focus was on legislation and regulation. And what do we have in the space today? So in 2013, New York City taxi medallion was valued at $2.5 million. By 2018, there were some reports of those medallions going at auction for $205,000. So the industry has been decimated in 5 years' time. And what about Lyft, the competition? So in 2012, they launched. They had 40,000 rides. By 2018, it was estimated they were serving 500 million rides in the year. And I don't know if anyone was watching, it was 2 weeks ago, they launched their IPO and raised over $2.5 billion and are now valued at over $25 billion. So this is another way that you could handle industry disruption. So looking at those two examples, I wanted to talk about what I think the opportunity is today for your world, and I'm doing this through my lens of hindsight. So having spent almost 10 years with John Deere, so that was kind of the big ag world, and then the last 2 years working with startups and the venture capital investor space. So with that lens, how would I use this disruption to innovate and grow? So let's just talk about what's happening in the animal ag space. Let's talk about the advantages, of course, of this world. You actually have customers. So all of these things are the envy of a startup. You actually have customers. You have product with demand. You have proven demand growth with rising incomes in the emerging markets. All signs point to them starting to increase their spend on animal ag products. You actually have revenue, something that's also the envy of any startup. And you have established distribution channels. So these are pretty significant advantages, and again, the envy of any startup or newcomer. But what about those startups and new entrants? So this is kind of the world I've been spending the last 2 years in, and there are some things that I just find really, I admire tremendously. The first being their willingness to fail repeatedly. So at John Deere, man, we didn't do very much unless all the I's were dotted and the T's were crossed, and we were pretty sure that it was going to be a winner. So there wasn't much real experimenting or innovating. It was very much not an innovation space, but a keep the wheels on the track and make sure that we're continuing to hit the mark as we have historically. So this idea of working with the startups where they will just try something, fail at it, take the learnings and move on was something I was pretty uncomfortable with, actually, to be frank. Was not something I'd been taught. And then something else that I really appreciate is they're taking a different lens on what they're doing. So they're attempting to solve problems. They're not just delivering solutions to the market. They really take things and look at it from a different lens of how could we do this better, or what are the problems today, and what would be under those circumstances, what would now be a solution to solve some of those problems. Something else very interesting is the responsiveness. So In established industries, naturally, there's been a lot of development of infrastructure and all of the channels that support getting the product to the market as it has always gotten to the market. But some of that efficiency doesn't leave room for being responsive to changes in the system. And it is a luxury that startups have, that because they don't have all of that history and established positions, they're able to be more responsive when they recognize that maybe one of their solutions isn't working. So I'll share an example from one. I worked with it was called Freight Farms, and they have, basically, it's a farming solution. It's basically a hydroponic farming solution in a freight container. So it's a plug-and-play solution. If you have a space to hold this freight container and you have access to water and electricity, you can start farming leafy greens, basically. And they brought me in to work on their distribution channel. So, okay, Renee, we're looking to finally really ramp up our sales. Can you help us understand what the potential distribution channels might be for this solution? And so we did it. It was a big project. And for them, actually, they spent quite a bit of money bringing me in to work on it. And by the time it was finished, they realized so paying attention to the units that they'd already sold, and then also looking at their customer base. So for those customers that they'd sold to, they recognized that maybe growing with really large volumes and putting those units out into the space didn't make sense. And what they actually needed to double down and refocus on was selling units and then figuring out a way to operate the units. So what they realized was that a large potential customer base were companies like Google and IBM, who we heard from yesterday, that they were very excited to have this in the parking lot and be able to tell their employees, we're serving you greens that we grew right here on the premises. But what they didn't want to do was actually hire someone to operate the unit. So while it was easy if you had electricity and water, it still required human labor to be able to actually operate the unit. So they totally pivoted their business model. So they recognized the opportunity and totally pivoted to starting to build a business where they were leasing the units and helping to actually operate them. It required totally new employees to be brought in because it was a different model, and also it was a change from what they had anticipated. So their willingness to do that and be responsive to what they were recognizing the customers were asking for was just something I had never seen before. I was just really impressed with their ability to do that. And then the last thing is challenging the status quo. Probably many of you are working with millennials, or you're raising millennials, or you are a millennial. And something that I admire, and someone called the other day, they called them the red flag generation, and they're willing to challenge things. They're saying, so what? You've done it this way for the last 50 years. There might be a better way. And why are you doing it this way? And, really challenging the status quo. And I see that time and again in the startup space where they're saying, it doesn't have to be the way that it's always been. And so these are kind of attributes of startups and new entrants that I think actually are enviable for established industry. And if there's a way to take some of this energy and bring some of these attributes into established industry, it can be a tremendous benefit and growth opportunity. So what is that? So what is the opportunity? So I think the opportunity is to use the momentum that a competitor is bringing into this space. So whether or not we think alternative proteins are ever going to grow to be a large piece of the pie, so what? Use the momentum that they're bringing to the space. They're challenging, so use it to challenge long-held assumptions that you've had about the business, about your operations. Something that I've been doing a lot about is thinking through the motives behind the suppliers and buyers in the chain. So what are the profit motives of all the players in the chain, and how can you potentially take advantage and use that? So from a grower's or producer's perspective, how can you take advantage and bring more of the opportunity to you? So specifically, what could you do differently? It is moderating efficiency with the responsiveness. So efficiency of supply chain or customer base is really optimal for large-scale industry. It is not optimal for smaller family operations. Those businesses need diversification, and that's actually not something that benefits a lot of your suppliers and buyers. And so I think there's a real important opportunity to think about how individual operators in the animal ag space can start to diversify their businesses. And just of note, a lot of the suppliers, so John Deere, my wheelhouse, they do diversify their business away from just corn and soybeans. So obviously there's a lot of money to be made in that space and the solutions that they have. But they have a construction business that helps to diversify their business. So they're not only on the agriculture cycle. They also have turf products to help them diversify their business. They also have John Deere Financial, actually, which is a whole nother different business. And so when you look at that and you see how kind of the larger players in the industry have diversified businesses, what is the opportunity for the smaller players to do the same? And then maybe looking at reevaluating what problems are being solved in the space. So while we might challenge some of the customers' reactions and kind of the soundness of their pushbacks, what is probably more important is to think about why. Why do they have these concerns? Let's just dig a couple layers behind. So if it's health concerns, or it's environmental concerns, or it's lack of trust in big ag, if we could just look at those examples and figure out, based on those and whether or not exactly how they're being shown is correct or not, what is the opportunity to address those and improve the bottom line of your operation? So how can you use those, again, to improve your profitability? And truly kind of stepping back and thinking about what are the drivers behind those concerns, and then looking at how you can take advantage. And so taking advantage, again, this is where the startups are just so envious of the things that you can actually do as revenue generating industry, is trying different things. So you can try things and you actually have revenue and a little bit of space to do that. And you also have access to an incredible customer base that, as we've seen, is more and more interested in talking to you. And why not use that advantage to try things and do things a little differently, and when they fail, taking the learnings and trying again. There's just so much opportunity to do that within your space, and starting off with things that are low cost and have minimal impact. It doesn't have to be huge changes. You can leverage well, actually, I mean, there's opportunity to leverage now a lot of the technology solutions to try things at a much lower cost. Just for example, I mean, Amazon actually gives people a platform to be selling things directly to consumers that never existed. I mean, even 5 years ago, it didn't exist. So there's a way to actually get right in front of consumers very quickly. And so looking at, as you look at kind of the animal ag space, there's a spectrum of businesses within the industry, some more durable and some more vulnerable than others. So on the durable side are those that will take advantage of the growth opportunities and be able to respond to the changing consumer demand. And on the vulnerable side, it is those spaces that are just hyper-focused on efficiency and cost reduction, which doesn't leave any bandwidth to actually be responsive and adjust as changes come in. So I think the tremendous opportunity is, in fact, to evaluate the diversifying opportunities. So as we have seen, the expectation is for global incomes to continue to rise, and with that will come customers across the entire spectrum of willingness to pay. So from the low end of those that are just starting to really increase their meat consumption to the high end where possibly people are decreasing their total consumption, but their willingness to pay when they're eating is growing. So it's a very interesting space, and the whole spectrum of opportunity is growing. And how can the animal ag industry post something similar to the coffee space, where the percentage of product that's being sold at a premium just rises, and then the actual folks that are benefiting from those returns are that we could see a position where those benefiting from those increased margins are in fact the producers and growers. And then the other opportunity that a lot of the concerns, particularly around the environmental side, is thinking beyond consumer goods. So putting the lens of a circular economy on. Actually, I think the agricultural space has always been very good at this. Not much is left to waste. But how could some of that be turned into more of a return? So thinking beyond the consumer products, and how can the industry as a whole be leveraged to deliver profitability beyond just consumer goods. So now I wanted to share, I did mention I work with startups, so couldn't leave here without sharing one. So this is Beef Trader. It is a Brazilian livestock tech startup that I work with. There's a live demo that I can show you when we have a break. But basically what they're saying is the situation that we have today at the feedlot is everything is average. So the group comes in, it's weighed when it comes in, and it's weighed when it goes out. But there's no understanding of actual information on each animal. And so what they're delivering is saying, how could we actually measure the profitability by animal? So how are they doing this? I wrote some notes so I wouldn't screw it up. So from the feedlot, so they're monitoring with scales and cameras, and they're getting 10 different data points per animal, so it's including weight, fat, and muscle deposition. And then the feedlot is providing the input costs and the diet composition. And then what they're doing, they're using a platform to collect and predict from the different slaughterhouses what the prices will be, so premiums and penalties. So they're using the information out there to predict. And then what they're delivering to the customer is optimization for profitability. So the platform calculates the profitability curve for each animal, and it crosses that with the market data and delivers to you information around the optimal time to send the animals to the processing facility. So this is live, and they're running it in feedlots in Brazil, and they're looking to come to the United States. A lot of you guys probably have gotten frustrated with this. A lot of the startups sometimes miss the so what. So they collect all the data, and then you're left with, what do I do with it now? And so this one is really delivering on the so what. That is their entire focus, is improving profitability. And what's exciting about this technology and many of the other ones that are coming up is that they're scalable. So they're scalable both up and down. So the costs are not in the hardware, the costs are in the software and analytics, and those are scalable. So you're charged per animal. So you can use this solution for a smaller feedlot or a very large feedlot. And historically, the industry as a whole has really focused on large operators, right? So everything has been towards bigger and better. But a lot of the new technology solutions are actually applicable to operations of all size, which is exciting and potentially a game changer, actually. So what if we knew? What if we knew what genetics consistently outperform? What if you knew the market demand for the animals before processing? What if you could actually share the story on positive environmental impacts that you're making over time? How about what if you could optimize the inputs at the feedlot to deliver on profitability? And what if you could actually deliver information that the customers are increasingly asking for about environmental impact per animal? Or what if you knew that you could predict what your premium products could be per animal? So there's a tremendous opportunity to ask some different questions about how the technology can be used to improve profitability. And so that is what I leave you with, that there's really nothing probably scary in this space, but what the opportunity is really just to understand. And for me, it's really understanding the motives behind customers and how you can use those to improve the profitability of this space. So thank you very much. Do we have time for questions?
We have time
great.
for a few questions. Renee, I'm going to ask you the first question. So you talk about storytelling and sometimes this disconnect. We talked a lot about the farmer as a storyteller yesterday, and where do you see us failing in that? What's your perspective?
I wouldn't say it's a fail. What I think actually is missing is maybe also the opportunity to think about how producers would actually also like to be hearing from their customers. So everyone talks about how important it is for the farmers and the producers to tell their story to the customers. But maybe what's also been lost over the last 60 years is for the producers to know who's eating what I'm producing. I mean, that's why everyone's in the business to begin with, is to feed people. And so I think there's a tremendous opportunity from both sides for connection, for growers to get a connection back with who's actually eating what they're producing. And then also, of course, for the customers to have a better understanding of what farmers are producing and how they're producing it and why they're producing it. Bringing back that history and the passion, because it's really hard work. And so sharing that story is really important in both directions, I think.
Renee, I have a question. Can you take a step back and kind of share with us what are the things currently happening in the alternative protein space? What are some of these alternatives you're alluding to?
Yeah, thank you. That's a great question. I had one other picture slide. I wonder if you could put that up. So this, it's going to be an eye chart. So I apologize in advance. Let's see if we can get it up. I wonder if you can, let's see. It's just a picture. I wonder, there we go. Yeah. So I'll need a little more. So I apologize to the other half of the room, but I'm going to go here. Let's see, a little smaller. There we go. So what you're seeing here on the top is what's happening. So this is the cellular ag protein space. So these are companies that are playing in that space. And in the middle, you have the plant-based protein companies. And then some of the alternative ingredient space that we're starting to see. And then what you also have is who are the players that are actually supporting this space, so helping to grow it. That's the yellow in the middle. And then who's actually funding these new alternative protein opportunities. First of all, maybe I'll share. So as I've been spending time in the venture capital world, again, it's been a very big departure from John Deere, where when we did something, it was because there was going to be return on investment. So when we got a project through the R&D pipeline, it was because we were pretty sure there was a business case for it. The venture capital world doesn't work that way. So the way the venture capital world works is they're throwing money at 10 different companies, and the anticipation is that maybe one of those companies is going to hit it big and give them a 20x return. So when you look at all of these companies, it looks very intimidating. But with the lens that I now have after having spent 2 years in this space, is that what I realize is that maybe 2 to 6 of these companies is actually going to come out and be a revenue generating business, which I would wager probably none of these are today. So that's one thing that I just wanted to level set, that while it sounds and it's very dramatic and there's a lot of energy around the space, in terms of actually being viable businesses, we don't know how it's going to play out yet. And we're still very much in the early stage R&D phase of this world. But in terms of what else is happening in the space, when you look at who's investing, I mean, this is what is pretty interesting. Some of these names you guys work with, right? So Tyson's up here. Cargill didn't make this list, but they're also investing in the alternative protein space. And this brings us back to the comment I made around business diversification. So the big players in this space are diversifying their businesses. And it just kind of hammers home the fact that that's something that also individual producers and growers need to also be doing. So this is kind of the big picture landscape. It is an eyesore. And JJ has a question?
I do have a question. May I borrow that? Perfect. So I noticed too, this is from Olivia,
Yeah.
who put this together, who I've heard speak, and she was at South by Southwest with a panel of venture capitalists. And I heard something at that you probably know more about than I do that I'd never heard of. There's also this growing trend of social impact investors. So what's the difference in what I would consider a traditional venture capitalist versus a social impact venture capitalist?
So typically, well, it's interesting. So venture capital are very, venture capital traditionally is high risk dollars. So people are willing to put money in high risk R&D enterprises. That's what the venture capital space is. Impact investing historically isn't necessarily very high risk dollars, but it is dollars that are looking to invest in things that are hitting, that are profitable. So it's not altruism. People are expecting a return. But it is also looking at companies that are delivering on positive environmental change, good social practices, and good governance. So that's kind of what I've understood of the impact investing. I haven't actually heard of many VCs that are doing social impact investing, but what I can imagine that is putting that high-risk venture lens on and saying, we're still looking for those high-risk opportunities, but we're also looking for companies that are nailing it on social, environmental, and good governance. So that would be my guess, though, again, my hesitation around that is I can't expect that doubling down on that and the venture stage would deliver the 20x return, but again, as I've said, the space is very confusing to me and doesn't always make total sense in terms of about their business decisions. So.
Hi, Renee. Thanks for a great presentation. So I have one question and one comment. So you talked about the regulatory aspect that, the taxi industry kind of fought with Lyft. So I was listening to something about the Farm Bureau the other day about, how much money they're spending in lobbying to try to actually regulate, well, not regulate, but kind of set a level playing field on these alternative proteins about who's going to regulate. Is it the FDA or the USDA? Because, as they talk, they don't mind competition, but they want to set a level playing field. So I think that is probably important to, to start with in this kind of disruptive technologies, that you have a level playing field to start competing against each other. What do you think about that? And the other quick comment is, you set the example about the feedlot and some technologies coming in, and we probably have an example here about the beef chain, which is implementing a disruptive technology and is actually producing a higher profitability and trying to bring some of those, increased revenue back to the producer. So that's an example.
Yeah, definitely. And if I'd known they were here, I could have put them in as the example. So yeah, you're absolutely right. So there's other solutions. I just know Beef Trader because that's the company I've been working with. But you're absolutely right. There are, and again, the beauty of a lot of these technologies is that they're scalable up and down because you're charging per animal. So there's solutions that are actually viable for smaller operations and the largest of operations, which is a game changer. Around your question on the regulation, you're absolutely right. There's, of course, important position around leveling the playing field. My concern is just if the focus is all about leveling the playing field, which, frankly, no one else is playing in the field yet, right? I mean, they're not even a viable business yet, nor do we know if there's actually going to be customers for that solution. My concern is just the focus of regulation and legislation instead of there's a shift. There are dollars flowing into this space, what's driving that, and how can we benefit from it? Like that to me is where the opportunity is. Yes, it's important to level the playing field, but it's equally important to understand what's motivating this change and then figure out ways to profit from it. That to me is also really important. And I think too often the focus goes, especially in the US, we like our judicial system, to focus on legislation and regulation.
Thanks, Renee. Rick Sybil. Renee, give us a little insight if you're a production person, it doesn't really matter if you're in the U.S. or China or wherever, you're strapped with not enough excess cash to explore. And what you just put on the wall is a whole bunch of people with a lot of excess cash to play this risky game of 1 in 10 hitting, but production folks who are trying to figure out how to survive the future, they don't have the excess capital to do that. Explain how we're going to bridge that gap.
Yeah, so I think this is so while there's a lot of money being thrown at the space, the actual startups are always cash strapped. They're always looking and having to raise money. So while they have some money to operate, it's not as if they have excess capital. And so what I think the opportunity is, and I understand that it's not as if there's tons of extra capital out there to be trying new things, but it's to look at what could be done from a very low budget perspective that leverages what the advantages that do exist in this space, which is customer base and distribution channels, and to leverage what exists to try things that are low cost and low impact. So just starting to try small things that are low cost and low impact. And then also what I think the opportunity is to look in the space and look at those who have been challenging the industry and are doing things differently. So what can be learned from those in the space that are doing things differently, and what could be leveraged from some of those folks to try different low-cost ways to try different things in the space. So I don't know if I answered the question exactly, but I do recognize that it's a pain point. But something I want to highlight is that while sure there's a lot of money being invested, I'll tell you that the startups are not rolling in capital. Oftentimes their costs are really high to get the R&D off the ground, and then they're also hiring really expensive talent. And so it's not as if they have tremendous amounts of capital to be spent.
Renée, thank you very much. We appreciate you being here this morning.